Every empire promises that your money is safe. Every government guarantees that its promises will last forever. But history has always laughed at those assurances. Rome fell. France went through revolutions. The Confederacy collapsed. Banks in Lebanon froze people out. Time and again, people woke up to see their savings evaporated, their salaries worthless, and their futures taken from them. Collapse is not rare. It is the norm. The real question is not whether financial systems fail, but whether you are left standing when they do. Money seems solid, but it is not. Money is only trust, and trust can vanish overnight. History is both ruthless and instructive. Every collapse leaves traces of those who protected their wealth and those who let it slip away. Notice this: the survivors were rarely the most trusting. They were the ones who questioned first. Take the Byzantine Empire, for example. After the fall of Western Rome, it was the center of Eastern Rome for 1,000 years. At its economic core was a gold coin called the solidus, so trusted that merchants across Europe, the Middle East, and Asia accepted it without question. For centuries, it was the closest thing to a global reserve currency in the medieval world. Yet the lesson from Rome's silver denarius should have been clear. Over time, emperors had debased it until it was nearly tin-coated. But the Byzantines repeated the same mistake with gold. They began to dilute it with cheaper alloys. Initially, no one noticed. Then trust broke. The coin that had sustained Mediterranean trade became just a political story. Paper promises or government edicts could not save it. Those who quietly held real gold or land outside imperial reach preserved their wealth. Lesson 1. Governments cannot resist the temptation to debase money, and when they do, real value shifts to things that cannot be copied. But not all collapses come from governments tampering with money. Sometimes the shock is unpredictable. In the 14th century, Europe faced one of history's deadliest pandemics, the Black Death. From 1347 to 1351, half of Europe's population died. Cities emptied, villages vanished, trade routes clogged. Yet the economic story was not only disaster. With half the workforce gone, surviving workers became more valuable. They could demand higher wages. Food and land, previously scarce, were now relatively abundant. Families with cash, silver, or productive capacity gained unexpected advantage. Land that once required great wealth could now be acquired cheaply. Vacant homes, untilled fields, the survivors found themselves in a buyer's market. If this sounds familiar, it should. During the COVID pandemic, similar dynamics played out. Supply chains broke, governments printed trillions, and those with cash scooped up assets while wage earners fell behind. In the US, home prices surged, the stock market rebounded rapidly, yet millions struggled to pay rent. Lesson: pandemics redistribute wealth. Always have. Survivors of the Black Death leveraged scarcity to climb the social ladder. Those with liquidity during COVID acquired assets others could no longer afford. While pandemics reveal how shocks can reshape economies, the collapse of banks in Renaissance Florence offers another lesson. Institutions that seem enormous can topple like dominoes. In the 1340s, Florence was Europe's financial capital, home to powerful banks like Bardi and Peruzzi. They had lent heavily to kings, most disastrously to England's Edward III. When Edward defaulted, the banks collapsed. Investors lost everything, trade halted, and Florence, once rich and powerful, descended into chaos. The ordinary citizen learned that size is not security. Lesson: the myth of too big to fail is as old as finance itself. Institutions exist to profit. When they fail, your savings go with them. From Florence to Lehman Brothers, from Lebanon's banks to today, the lesson repeats. Survivors are those who understand that promises only hold as long as the institution can honor them. The American Civil War teaches a similar financial story. Both North and South printed money. In the North, the greenback was introduced, paper money not backed by gold, only by the promise of the United States. It seemed bold, patriotic, and even revolutionary. Yet as greenbacks flooded the economy, purchasing power fell, inflation rose, and trust faltered. In the South, the situation was worse. The Confederacy, short on resources, printed massive amounts of graybacks. By war's end, inflation had skyrocketed, prices multiplied, and soldiers' pay became nearly worthless. Families carried paper that could not even buy a loaf of bread. Tangible assets, land, food, gold, retained value. Ordinary Southerners suffered a lifetime of lost savings. Opportunists turned the war into a chance to acquire real wealth. Americans rarely remember that their own country experienced a currency collapse. Protection comes not from paper in your wallet, but from owning value that cannot be printed. France offers another cautionary tale. Revolutions can destroy money faster than wars. In the 1790s, revolutionaries overthrew the monarchy, seized church property, and issued a new paper currency called assignats. The notes were theoretically backed by confiscated property, intended to stabilize the economy. But the government kept printing more. Each new issue diluted the previous one. Prices soared, salaries lagged, and the assignats rapidly lost value. Farmers demanded food or silver instead. Bread riots returned to Paris. The revolution devoured itself. Winners were not paper holders, but those holding food, gold, or property, the things government could not print. Ordinary Parisians learned, often too late, that promises are only worth what others will accept. When trust collapses, savings do not just shrink, they vanish. 2 centuries later, the lesson resurfaced in Asia. In 1997, speculative attacks on Thailand's baht sparked a regional crisis. Thailand had borrowed in dollars, relying on a fixed exchange rate. When it collapsed, foreign debt became unpayable overnight. Investors fled. Currencies across Indonesia, Malaysia, and South Korea fell. Economies contracted. Unemployment surged, and governments turned to the IMF for aid. The biggest losers were not global hedge funds, but ordinary citizens whose debts and mortgages lost value. Yet again, those holding foreign assets or tangible wealth survived. Countries in debt had to tighten belts. Wall Street found cheap assets. History's lesson is constant. Borrowing in someone else's currency is dangerous. When the storm hits, the borrower drowns, not the lender. Even today, examples abound. Between 2019 and 2021, Lebanese banks suddenly closed. People found their savings frozen, unable to withdraw or access investments. The Lebanese pound lost 90% of its value. Decades of savings disappeared overnight. Not just small savers, but middle-class families, doctors, engineers. No one was safe. The lesson is harsh but clear. Your money in a bank is not a treasure chest. In a crisis, it may not be accessible. Survivors were those who diversified abroad, held gold or real estate, or kept cash outside the banking system. The rest were trapped. In 2008, the U.S. saw a similar scenario. Homes were foreclosed, retirement funds wiped out, but the banks that caused the crisis were saved. In 2020, trillions were printed. The rich saw their assets grow while wage earners stayed in place. In 2023, regional banks collapsed overnight. The too big to fail myth remained just that, a story. So how do you protect yourself in a collapse? History shows there is no single answer. Gold worked in Byzantium. Cash allowed post-Black Death survivors to acquire land. Avoiding too big to fail banks worked in Florence. Tangible assets mattered in the Confederacy. Food and property held value in France. Avoiding foreign currency debt mattered in Asia. Being able to withdraw cash before a bank closes mattered in Lebanon. The patterns change, but the theme is constant. Survival does not come from blind trust in paper or institutions. It comes from recognizing and holding real value. The paradox of collapse, disaster for the unprepared, opportunity for the prepared. After the Black Death, peasants acquired land. In 2008, cash-rich buyers obtained homes while millions lost theirs. History shows protection is not only defense, it is the ability to seize what others are forced to relinquish. Wealth is not just what you have, but what you can do. Survivors in history were not only gold or property owners, they were value creators, bakers providing bread, craftsmen repairing tools, farmers feeding communities, merchants moving goods across borders. In crises, money loses value. Production never does. People still need food, shelter, trade, life. Those who provide it rarely remain poor for long. The deeper lesson, blind trust, is not protection. Real assets, real skills, and the recognition that illusions always collapse are. Every crisis is a transfer, from the trusting to the prepared, from paper promises to tangible value, from passive savers to active producers. History repeats this endlessly. The question is no longer, will everything collapse? Everything always collapses. The question is, will you be among those who cling to promises, or among the minority holding real value? History does not repeat itself, but if ignored, it will crush you again.